find out what's going on in your money and see what's going on. What's happening to your IRA and 401k? Friday, I kind of got surprised by the employment report because on the top line, everything looked like it was going to be one of those good news, bad news days, and then you dug a little deeper and things kind of skyrocketed. Phillip Statler from Statler Financial Services is here on the phone this morning. And Phillip, I gather you were as surprised as I was on Friday, weren't you?
Yeah, I really was, Dave, because I saw those numbers as well. And I thought, oh, man, that looks good. And so that means to me the market was going to fall that day. And as I continue to watch every now and then after I got through with meetings, it was crazy that it bounced so high.
You know, this was the perfect picture of a market looking for a reason to be happy. We said we got down to a Trumpian unemployment rate. We were down to 3.5%. We ended up with a big overachievement in terms of the number of jobs added, which, like you said, should be a ticket for Wall Street to go, oh no, we're going to have a big interest rate increase on February 1st. But all of a sudden, they went a little bit deeper into the report. Wage growth leveled off. All of the inside numbers that come in, wage growth, hours worked, and number of continuing claims, pretty much all leveled off a little bit, and they gave everybody the idea that, well, maybe the outside chance of having things settle down on the employment front in the coming months might happen. And you know, it's all tea leaf reading from those numbers, but doggone it all, it made Wall Street awful happy, didn't it?
It did. And I'm looking back at some of the other numbers on Friday that don't really get talked about a lot. And I'm going to think that there's probably two numbers that may have helped us really bounce off. And that's going to be a fall in the ISM service index. Mm-hmm. It fell substantially lower than expected, as well as factory orders. And I think that one may have probably been the ticker that really helped the markets. Because it fell about 0.7 more than expected. So it was down almost to 2%, 1.8% fall in factory orders. And so I think that was one of the things that probably looked at and the market said, oh, we're not ordering as much. That means people are cutting back. Maybe the Fed's finally impacting the consumer. And so that could have driven everything higher as well.
And that actually does make some sense because the real curve upward really got decided starting about 10 a.m. when those numbers came off. And Macy's basically said the same thing. We got one of those really crummy guidance statements out of Macy at the end of the day on Friday. I think they're probably figuring they'll get buried over the weekend, but we actually watched that junk. They're expecting net sales and their adjusted earnings per share numbers when they report later on this week to be on the low end of the range, which wouldn't necessarily be bad, but the big comment was from management saying, based on current macroeconomic indicators and our proprietary credit card data, we believe the consumer will continue to be pressured in 2023 and have planned inventory mix and depth of initial buys accordingly. That's about as close to saying, hey, we're pulling in our horns as you can get, isn't it?
Yeah, I think so, Dave. I think that really is. And it goes along with, I know we're probably not ready to jump to this one yet, but we will. And that goes along with some of the stuff coming out from Goldman Sachs. Because Goldman rolled out a new credit card and installment loan program this last year. And they're talking about in this report that I read that they could see a $2 billion loss, pre-tax loss out of just that division.
Crud.
Yeah, so that's a pretty big deal. And that's a pretty big loss.
I was going to say, Goldman has not been known as being a consumer credit card company, but they kind of put their toe in the water by backing Apple's credit card program, and evidently it's done well enough for them. They took a chance, but they could get bit on the bottom now, huh?
Well, yeah, and it's looking back at last year and saying that they lost about $2 billion. I'm thinking, man, somebody maybe messed up somewhere in that process.
Start to think so. I've been seeing a bunch of consumer credit ads for Goldman as well on the cable news channels, and it almost sounds like they decided to dip down into getting people with some marginal credit to get into it as well. I mean, Apple's supposedly a premium card, but the Goldman Sachs ads on TV indicate they're actually after the cash card people as well, which is almost a guarantee that they're going to have some marginal write-offs, isn't it?
Yeah, it really is, and so that's yeah, I think we'll continue to watch the debt and the debt deal, especially consumer debt. Not just credit cards, but I think we're also going to see the whole deal with auto loans. We've talked about over the last several quarters, we've talked about how that's probably the next big thing that's going to hit is the subprime auto market. We'll probably start to take a pretty good hit, just like credit card companies will take a pretty big hit.
Absolutely. With the premium price on used cars that they've been maintaining for the last few years, and being able to get what really isn't a particularly fancy new car for the 30,000 range, it's there's a pretty substantial debt load there that's cruising for a bruising if the economy takes the kind of dip that some of us are afraid it's going to.
Yep, that's true. And talking about jobs as a whole now as well, Goldman came out, and I know you talked about it last week a little bit, but this week they're basically saying that this is the week that they're firing 3,200 employees. That's a pretty big deal coming out of them. Now it is still less than 10% of their total employment situation, but still that's a big jump to have to folks out there having to find a new job.
And when you talk an investment banking firm like Goldman, we're talking about some substantial waged white-collar workers as well. This isn't exactly the low end of the workforce they're letting go.
No, it's really not. And so that's going to be the question is, how easy especially in that industry, because I think we're going to see that industry, not just Goldman, but other investment banking firms start to lay off more people because deals are going to get shorter and shorter in this economic situation we're in now. They're not going to see the M&A that we've seen, in the last 2 years. It is going to kind of fall off now because of the recessionary times we're going to fall in.
We're going to take some pauses in that action, no doubt. Setting the table, we had a big day. Talking about it, we had a big day on Friday. Every major index was up over 2%. Dow was up by 700. Standard & Poor's was up by 87. NASDAQ up by 264. And that was reflective, they said, on some of my tip sheets, as conventional wisdom starting to shift toward favoring the possibility of a soft landing with the recession everybody expects us to have next year. I'm not quite ready to go out on that limb quite yet, are you?
No, I'm not. I wish I could say that, yes, I think we'll definitely have a soft landing, but I'm not there yet, Dave. I just don't think that anybody can say that. We haven't been long enough with these higher interest rates to be able to say, yeah, we're going to have a soft landing, because not enough of them have taken effect yet. I think that now by the end of this first quarter, maybe we will be able to see that actually coming through. But until the end of this quarter, when we've got another couple of those interest rate hikes in place, I think it's too hard to say right now.
I agree. That kind of it squares to what you and I have been preachifying for a long time. In March, we'll start seeing the effects basically of what they did to us in October with the 0.75% they gave us then. Then we'll have three of them under our belt. We'll have a reading as to what the economy looks like. Right now, we've got the beginnings of indications that it's having a little effect on an overheated employment market, but it's way too early to be able to call a soft landing yet. And I'm still crossing my fingers they're right, but I ain't thinking that it's necessarily something I can call yet.
Yeah, me either. And I'm looking at, I think I saw an article last week maybe that was talking about interest rates and the Fed, the next meeting. And it seems like there's a feeling that 50 basis points was kind of what most people were thinking. But after last week's, what people were looking at last week, there is some folks now that think maybe we'll only get a 25 basis points bump the next time, and I'm thinking either one of those will be better than what we've been dealing with lately.
Absolutely. They're going to be going into blackouts sometime in the next week and a half, 2 weeks or so. But any rubber chicken circuit speeches made, especially by the new governors on the Open Market Committee, going to be things we're going to be watching real carefully over the next couple of weeks down the line. It's earnings season starting later on, I would imagine later on this week. Have you got a calendar where we're actually going to get some reports from companies we've heard of?
I haven't looked at companies. I know I saw an article I was reading in that Goldman article I was reading actually that they expect the financials, the banks, to start reporting Friday. So I haven't really looked at that. I'm not 100% certain of that. I haven't looked at that. I was looking more at what do the numbers look like for us economically this week. I know consumer credit comes out late today. Not much tomorrow, except for the federal chairman, Mr. Powell. He's over in Sweden. And then Thursday, obviously, is Jobs Day. But Thursday is Consumer Price Index Day. So we've got the CPI coming out on Thursday, as well as jobs. And then Friday, import prices come out on Friday. So that's kind of what we're looking at from the economic standpoint.
And the CPI reading could be real important come Thursday, given what we're looking at as far as the employment reaction that we had earlier. It'd be nice if the CPI leveled off a little bit to kind of confirm that we were having an impact.
Yeah, it really would. I just pull up my schedule real quick. So Friday, not a bad day. You got Bank of America, you got Citigroup, you got Delta Airlines, First Republic Bank. Let's see what else we got on Friday the 13th. What a good day to report, right?
Yeah. It's got to be Macy's for Friday the 13th, given the guidance they put out.
Bank of New York comes out then, Wells Fargo, and United Healthcare. So Friday's going to be probably the big day. I mean, there are a few companies reporting before that, but not many.
I was going to say, you warned me about one that neither one of us had even heard of coming out this morning early on, right?
Yeah, it's one, like I said, it's not a common name, but it is it's a company that does women's diagnostics testing. It's called Hologic. And so they did better than expected, both top and bottom line. They actually announced their earnings yesterday. And so they're trading up this morning about 2 3/4% before we get going.
Ouch, okay. Once again, setting the table, up day on Wall Street on Friday. I'm not seeing any major surprises on the pre-market moving. Bed Bath & Beyond on Friday announced that they were heading toward bankruptcy, and that's pretty much making them lead our big loser list this morning. Other than that, I'm seeing some green on the futures. Where are we this morning, 45 minutes early?
We still have some green out there, Dave. We got the Dow up about 0.3%. That's a little less than $100. So we got the S&P 500 getting close to 0.5%, about a little over $17, and the Nasdaq 100 up 0.6%, or about $66. So everything's looking good on that standpoint. We look at the commodity side. We've got silver still up above $24 an ounce, not by much though, up about 0.25% this morning. Gold up, it's trying to get up to $1,900, Dave. It's getting really close to $1,881 an ounce right now. That's up a little over 0.6%. Crude oil, it's up from Friday's close, but it's down from kind of where it's been bouncing around since the beginning of the year. But it's up 3.25% today to $76.17 a barrel right now.
It's a little more than it was on Friday, so I'm not necessarily ecstatically happy with that. We were down to $74 for a while over the last week.
Yeah, that was nice. When I was out in California for my meeting, I saw actually gas in the $4 range. I thought, well, that's pretty good for California.
In California, that's almost earth-shaking. Overseas markets, generally, everybody's happy. The Asian Rim was evenly up at the close at 6 a.m. this morning. Hong Kong by the better part of 2%. Europe is up uniformly, but fractionally halfway through their trading day. Keeping tabs on your retirement counts for a lot, but watching it day by day means you probably have too much risk in there. How do I find you to get the risk out of my retirement plans, Phillip?
Folks, give us a call at 863-382-0037 to walk through our core retirement design, where we'll analyze your portfolio, analyze your retirement plan, make sure you're on the right path for the retirement you always dreamed of. And then catch us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. on Sunday on Highlands News Talk 730 and 95.3 FM.
And back here again tomorrow with another look at finances as to what could affect your money tomorrow. Phillip, thank you so much. We'll catch you then, all right?
All right, take care.
Be well. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
And folks, again, I want to thank you for joining us. I hope your year is off to a great start. Join us again tomorrow, same time, same place. Until then, have a great one. Bye now.